Thank you for joining me today for the third part in the six-part series on financial visibility. My name is Bill Sablan, and I'm a partner with Now CFO, which is the national firm for outsourced operational accounting and finance services. Today, we will be going over the importance of budgeting and monitoring variances. Financial visibility is the basis for making smarter business decisions. It's with that in mind that we are going over the ways we can overcome 5 critical mistakes that most businesses make when they are starting out. What we learned last time is that you need to use management accounting, not just financial accounting. And what we'll go over today is why budgeting is so important. In future parts, we will go over what it means to close the month, how to forecast and manage your cash flow, and the importance of dashboards. Understanding these 6 areas will put you ahead of the game and give you a solid foundation to grow your business. For those who missed the first part, let's quickly recap the concept of financial visibility. When we say financial visibility equals smarter business decisions, what we're really saying is that you're making decisions based on real data and not by gut feel or a hope and a prayer. Financial visibility means that the financial data is accurate, timely, relevant, and insightful. And that takes us to part 2. Financial accounting looks backwards. For example, preparing tax returns or financial statements. But management accounting is how we take the financial data and use it to run our business. It's things like forecasts, budgets, and models. It's looking forward. So now we're going to talk about one of the key aspects of management accounting, budgeting. Most people understand the idea of budgets. From a basic standpoint, a budget tells you how much money you can spend. A great deal of care should be taken when creating your budget. A lot of businesses start the process in September, August, or even earlier. There should be a budget for the overall business, for the different departments, and even individual accounts. The budget should be annual and monthly at least. You will use this throughout the year to make decisions on spending. Now, most people come up with their budget by thinking about it like their income statement. They start at the top and estimate revenue, then they budget their expected expenses, and whatever is left is their profit. This is a straightforward way to do it, but it's not the optimal way to approach the budgeting process. So what is the best approach? First, ask yourself why you got into business. For most people, the answer is to make money. Even if you are a nonprofit, you need to make money to grow the organization. So start by asking yourself how much profit you need to make to consider it a successful year. It's possible that answer right now might be to just break even, but that answer will likely change each year. So figure out that bottom line number first. Then you need to start projecting your revenue. But be realistic. If you project a very aggressive revenue number and don't hit it, it can put you in a bad position relative to your spending. So if you have your bottom line and you've projected out your revenue, what's left is your total expense budget. That's how much you can spend. Now you know how much you can spend in total, which means it's time to start allocating that money to the various departments. Operations, sales and marketing, HR, IT, etc. Then you should allocate that budget to the individual accounts within each department. Having a budget for the whole year is a good start, but it's even more useful if you can take it to a monthly level. It's possible that some of the accounts can have a monthly budget that is just the annual budget divided by 12, but if there are seasonal variances or expenses that come up quarterly or annually, budgeting for those items in the correct periods will save potential mistakes during the year. For example, you might budget $12,000 for software subscriptions, and so you just enter $1,000 a month. But let's say of that $12,000, there's an $8,000 annual renewal that takes place in September. You could be in June thinking you had $6,000 to spend, and you've only spent $3,000, so maybe you can splurge on some new software because you're still under budget. Then, when September comes, you don't have enough left in your annual budget to renew that key software, and now you're over budget. That's why we say you must take care and take time to create a proper budget. But you're not done yet. As indicated by the example we just talked about, you have to monitor your actual spending versus your budgeted spending. Look at it on a monthly basis and also where you stand on a year-to-date basis. The reason you want to look at both is because being over budget for the month is less of an issue if you're still under budget on the year so far. It doesn't mean you ignore it. It could be a red flag that spending is trending upward and you're in danger of going over budget for the year. It could also just be a one-time blip. But the point is that you've looked into it and now you have insightful data to make decisions on future spending or potential cost cutting. Now that you have the relevant data, you should be meeting with the relevant people. For some startups, that might be just you and your partner. If it's just you, maybe it's a meeting with a key advisor. but you need to be discussing the results and what it means. This is how we use budgets as a part of management accounting and how financial visibility is the cornerstone of it all. This was obviously just a quick run-through on a process that can take months and is also an ongoing part of running a business. Please feel free to ask me any questions you have during the chat session. And if we don't have time to get to everything, or you're interested in getting help on your budgeting process, feel free to contact me anytime at bsablan@nowcfo.com. Thank you.